communities in Nebraska. Dr. Merriman is the interim dean and Stuckel Presidential Professor in the College of Urban Planning and Public Affairs at the University of Illinois, Chicago. He is also a distinguished fellow at the Lincoln Institute of Land Policy. Professor Merriman has done extensive research on tax increment finance, business tax incentives, and property tax assessment caps. Some of you may recall that Dr. Merriman presented at our 2016 January symposium ahead of a legislative discussion about assessment cap proposals. So we're thrilled to have Dr. Merriman back with us today. Dr. Merriman will begin his presentation, and that will take place for roughly 25 minutes, and then we'll open it up to the audience for questions. Just a few housekeeping notes before we get started. Today's webinar, as you just heard, is being recorded. Video of the webinar will be distributed on our listserv and posted on our website in the coming days. Dr. Merriman's slides will be available after the webinar as well. Attendees will be on mute the entire time. And if you have any questions, please type them in the all sorts of fun today. All right, if you have any questions, please type them in the Q&A box at the bottom of your screen. Please limit your questions to 2, which will make it easier for us to monitor and will allow as many people as possible the opportunity to ask questions. And we will do our best to get as many of those questions answered as possible. And with that, Dr. Merriman, hopefully the rest of the day will be go smoothly technology-wise, and we will go ahead and turn it over to you.
Thanks so much. So first challenge is to share my slides. Stop other participants' computer sound share. Do you want to continue? I guess yes is the answer. And hopefully that's good. And oh, I got it.
Yeah, can you?
I have to get.
Yeah. Slideshow. Yeah. There you go. Perfect.
Okay.
We're good.
Okay, great. Thanks very much. You know, I want to say, as Renee said, I came to Nebraska about 5 years ago and talked to a bunch of people there, and I remember that visit very fondly, and I was very impressed by the quality of the discussion about public policy there. So I hope that you're continuing that tradition. And so what I want to talk about today is sort of good intentions don't always result in good results, and some property tax fixes. I understand some of the issues that you're struggling with, and I just want you to think carefully about how you can address those challenges. So, okay. And so this little diagram sort of illustrates that point. You know, the very nice guy sitting in the chair is thinking he's solving a problem by pushing the dominoes over with, I guess that would be his left hand. He's about to get bopped in the head on his right side because he's not thinking through all the consequences. So I just want to make sure that you do try to think about the consequences and the long-term effects of any policies that you might consider. And as you do that, this is the agenda that I'll go through and talk. I want to talk a little bit, first of all, just about the criteria for evaluation of a property tax or property tax policy change. If you're thinking about changing something, what criteria should you use to determine, you know, is this a good or a bad change? And then I want to talk about the particular circumstance that we're in today with COVID, and particularly with respect to local government's fiscal condition. You know, COVID has been just an incredibly important event, I think, in this country in many, many ways. It's gonna affect the economy, I think, for decades to come. And I think we need to think about how that interacts with public policy. And then I'll spend some time thinking about fixing the property tax. And in particular, I'll talk about assessment caps, and then a little bit about rate caps and spending or revenue caps, and then some alternatives to these policies. So that's where we're going. So first of all, the criteria, and this is very standard sort of textbook criteria. I didn't come up with these myself. Very standard textbook criteria for thinking about any kind of tax policy or tax policy change is to think first about fairness, or economists often call that equity. But basically, how does it affect people, and particularly how does it affect people at different levels of the income distribution? More well-off people versus less well-off people. And people have different values about what the appropriate distribution is of the responsibility for paying for government along the income distribution. So it's sometimes hard to get consensus on whether a tax change is fair or not. But at least that issue ought to be discussed openly and with as much data and sort of rigor as possible. The second thing that economists make a big deal about, but I think it is important, is efficiency or neutrality. How does a tax policy change affect the operation of the economy, and how does it tilt the playing field toward one activity or another? What's the right way to do that? A third issue is revenue stability. This is very important for governments. If you're going to try and raise more revenue, you need to be able to plan, and you need to be able to deal with the fact that we live in a capitalist economy that has economic cycles, as we've seen kind of amplified in the COVID recession. And so you need kind of to think about, is this really a sustainable revenue system? Is it going to be possible to manage your revenue as you make a policy change? And then the last two are more important, I think, in the political science realm, but they're also important to the, sort of the average citizen. Any tax change that you have has to be administered. And what we want to do is make things that are relatively easy to administer, so the government can administer it in an easy way, in a fair way, a way that is perceived to be fair. And then we also want it to be predictable, and we want it to be predictable both to the taxpayer and also to the government. So we want to know how much revenue we're going to raise over time, and we want it to be visible. So we want people to understand how much they're paying and what they're getting in return, right? And so, and why they're paying that. So all of those things are related. And I guess this last topic on visibility is to some extent related to fairness as well. If people perceive the tax to be based on a rational basis, then we're likely to think it's fair. Okay, so that's an introduction. And now I want to talk a little bit about COVID. So when COVID came in March 2020, many of us were just scurried to our computers to try and figure out what this would mean for the economy as a whole, and in particular in my field, for what it would mean for government resources. We had, obviously it's not just COVID, but it was the shutdown of the economy related to COVID. And we had a couple of very good economists. I think Howard Chernick has actually been worked some in the past with OpenSky, and they attempted as best they could to kind of predict the effects on local government revenue. And the effects on local government revenue, they did it for the country as a whole, and they found most cities would lose somewhere between 5.5 and 9% of their ability to provide services, is what they thought at the beginning of the recession. And they did it for particular cities. So they looked at Lincoln and Omaha in particular, and they're more or less average, a little less actually. Nebraska seems to be a little less severely affected, or was predicted to be a little less severely affected than other places. And then we could look at what actually happened. And we don't have it broken out. We don't have the most recent data broken out by local government. So we have to look at state and local government together. But you can see kind of what happened with total tax revenue in the first quarter of 2020, which was mostly unaffected by COVID. We got a set of revenue, which we might call 1, and indexed at 1. By the second quarter, revenue fell off quite a bit. And then it came zooming back in the third quarter went down again in the fourth quarter, and now is up again. If we look across the different revenue sources, we can see that the property tax was the least affected, right? For kind of obvious reasons, the property tax is taxing an asset rather than a flow. So the value of assets didn't adjust that fast. If you look at the income tax, though, you saw a big cut in income tax revenue in the second quarter, and then it zoomed back in the third quarter, and then it fell again in the fourth quarter, like that. And that's even more true with corporate tax revenue. With sales tax revenue, again, you see that kind of volatility over time. We have a little bit of data relevant specifically to Nebraska. And you can see, we don't have property tax data for Nebraska, but you can see the income and the sales tax revenues, had that kind of very volatile path over time as you went through the COVID recession, right? So the corporate income tax, corporate receipts fell way down, as did individual receipts. The sales tax in Omaha and Lincoln both fell quite a bit relative to where they had been the previous year. And then they have recovered somewhat. I should mention, when we see the recovery, I mean, that recovery looks really good, and the economy actually has come back quite a bit. But remember, that economy and that recovery was spurred because of massive federal government spending, trillions of dollars of federal government spending to kind of keep the economy going. And if it hadn't been for that, we don't know quite what would have happened in this recession, but it's unusual. This is a very unusual federal response to a recession. So when we think about the future, we want to be aware that difficult economic times are going to cause a lot of volatility, particularly in the income and the sales tax revenue. And you can see the second quarter highlighted, since that was the kind of the biggest difference. Where does revenue come from? Well, some of you may already be aware that property tax is a very important source of revenue in Nebraska. It accounts for 37% of all revenue, compared to 30% in the nation as a whole. And that's a lot of that is because intergovernmental revenue in Nebraska is a much smaller share of state and local this is local government revenue than it is in the United States as a whole. So when we talk about the property tax, we're talking about a really important source of revenue, particularly for local governments in Nebraska. So what do we know about what happened during the COVID recession? And I don't mean to suggest that it's over. We really don't know if it's over. We hope it soon will be. But what we know is that fiscal 2021, which ended for most local governments in June of 2021, was hard on local governments, but there was a strong recovery by the spring. Property tax revenues held steady throughout early 2021. In many areas, sales tax revenues fell dramatically early in the pandemic, and similarly, income tax revenues were very volatile during the pandemic. And income tax revenues are important not only because in some places local governments have an income tax, but also because they affect state government revenue and the ability of state governments to give local governments aid. I think more important than thinking about the past is thinking about the future and how COVID is going to affect the future. And I think there's at least the potential for COVID to have quite a big impact in the future, particularly on real estate. So one of the things we're seeing, certainly in Chicago and in other cities, I don't know exactly how much you're seeing it in Nebraska, is that work from home will increase greatly and commercial real estate prices may plummet. So there's a lot of offices. Those offices there's much less demand for them. That's going to drive the value of the offices down. On the other hand, people are going to be working at home. They're going to want bigger homes. They're going to want offices. That can increase home prices. Demand for residential real estate may rise and home prices might follow suit. It's not clear to me what will happen, if anything, to agricultural parcels. I know that's an issue of concern in Nebraska, where you have a big agricultural sector. Property tax obligations may shift from non-residential to residential, particularly in urban areas, because the non-residential property, there's just going to be less demand for it, particularly with office space, particularly people buying things through remote sales. It may hurt commercial businesses, etc. In addition, there can be regional shifts that might advantage less dense regions. So I know here in Chicago, we're seeing people moving and working completely remote. And often they're going to places, I don't know how many of them are going to Nebraska, but they're going to places that are less dense, and they're going to places where housing prices are cheaper. And so that can have an effect as well. And the last point I'm pretty certain about, there's going to be substantial reductions in federal intergovernmental aid. We don't know exactly how rapidly this will happen, but we know it's starting already. And what you may look like healthy state and local government budgets may be much more exposed to weakness as federal aid is reduced. We just don't know exactly how that's going to play out. I know that it's a major concern of mine, what's going to happen in my region over the next year or so, because there's a tendency for less than perfect planning about what we'll do when we lose the aid that we got this year. What do we know specifically about Nebraska with respect to the residential market? Well, we know that home prices are rising. I understand they're rising relatively fast, and that this started even pre-COVID. So I found some newspaper articles which said that there have been, increases of around 6 or 7% over the last 3 years in Douglas County, and that's very substantial when you start getting a 6 or 7% increase for multiple years. The size of the real estate tax base goes up. And there's a particular concern that in the future, again, the home prices may continue to rise, but there might be less increase in non-residential property. And so that might change the balance. First, let me give you a little bit of context of Nebraska versus the rest of the US. So, and the blue line shows Nebraska home prices, an index of Nebraska home prices, and the red line shows US home prices. And what you see is that Nebraska home prices have risen slower than the United States, and they've been less volatile than the United States. They've risen over time. And in recent years, you do see, picked up what you saw in the last newspaper article, you see, a pretty good steep increase in home prices. But they're still got a long way to go if they're going to catch up to kind of the US increase. And historically, they've been much less volatile, which is a little easier to handle. So, and particularly around the 2008 recession, the volatility in home prices in the US was much, much greater than it was in Nebraska. It was barely a bump in Nebraska compared to the rest of the US. And you did see some declines, but because you saw less uptick, you saw less declines in Nebraska than elsewhere. So this current increase is something that doesn't really look out of line with many, many areas in the United States. So are increasing housing prices a fiscal problem, or to what extent are they a fiscal problem? So let's go back to the very basics of thinking about the property tax, or really any tax. Tax revenue equals the tax base times the tax rate. In the case of the property tax, the tax base should be equal to the value of housing plus the value of other real estate. So I'm talking here about market values, right? And so it's housing values and other real estate. And so in and of itself, an increase in the tax base is not problematic, at least if government's working well and government's responsive. Elected officials can reduce tax rate to prevent tax revenue from rising when the tax base grows. So if you're worried that tax revenue is going to go up fast, the tax base increasing alone won't do that. You need, it also depends on the tax rate. And there's some evidence, actually by a professor, John Anderson at the University of Nebraska, that in fact there is some reduction in rates as the value of real estate increases. So we don't, it's not, politicians don't just keep the same rate, but they do somewhat take into account that the tax base is increasing. I want to suggest this is reassuring to some extent, but even in this case, if housing grows much faster than other real estate, which I think is likely to be the case and may be the case, particularly in Nebraska, the tax burden will shift toward housing, and that could be undesirable. So if you're thinking about how much should residential taxpayers pay versus how much should non-residential taxpayers pay, if you get value of housing going up very fast, that could be problematic if it's not balanced with other real estate, because you might get more of the responsibility for paying for government shifted onto homeowners or shifted onto people who live in houses. So if we think of this as, you know, a problem that you potentially have, how do we fix it? And so the first thing to think about is to take a deep breath and realize that the cure can be worse than the disease. Lawmakers want to fix property tax vices, but they can create new problems if they don't carefully think through the unintended consequences, which is why I'm very glad to have this discussion with you today. Let's think about the potential consequences of fixes that you might consider. So one thing that I understand is getting some discussion in Nebraska and has gotten discussions elsewhere, excuse me, even in my own home city, is assessment caps. Assessment caps limit the growth of assessed values either to a fixed percentage like 7% or to some measure of inflation like the consumer price index. So they're fixing they're separating the value of the tax base from the value of the underlying asset. Often that's housing. And we in Cook County, where I live, in the county that covers Chicago, we put in an assessment cap some years ago. And after the assessment cap had been in place for a while, I was asked with some co-authors to do a study of it. And what we found really is not surprising in retrospect. So this shows the Cook County is divided into 3 regions: Chicago, the north suburbs, and the south suburbs. And we found that assessments did drop in the places among the parcels and in the places where the caps were. And so, for instance, Chicago had a 14% decline in the amount of property tax owed in the first year of the assessment caps. But what that did is it pushed the tax burden onto other areas, and it pushed it. So the assessment cap was only for residential housing. It pushed it onto businesses, and it pushed it on, more importantly, probably to renters. Okay, and often the renters were lower income than the homeowners, and so it had very questionable kind of fairness implications. And over time, the burden changed. And we also found that the burden changed rather arbitrarily, that some areas where they had very fast increases in assessments were able to save quite a bit of money on their taxes, while other areas actually had an increase, even though they were by law subject to the assessment cap. And one of the problems with assessment caps is they violate the principle of horizontal equity. That is the idea that similar types of people should pay similar taxes, because similarly valued parcels will pay different taxes depending upon when the increase in their assessments happen. It can also violate the principle of vertical equity, and we found that it did, since lower valued parcels may pay more tax than higher valued parcels. And ineligible parcels bear the burden of the tax relief. And further, this kind of inequity snowballs so that other groups demand group-specific special property taxes break. So if you put one group in and you give them an assessment cap, then the businesses came and they said, well, you gave households an assessment cap. Why don't you do something for us as well? And the result is a hodgepodge of kind of different tax breaks for different groups. And it's hard to tell the total effect. Assessment caps can also have other effects that can create lock-in that reduces mobility. So very often assessment caps are put in place such that the assessment is capped until you sell the property. That's the case in California. It was also the case in Michigan. And as a result, you get people who are kind of trapped in their home because they got a pretty nice home, but they can't really sell it for what it seems to be worth because the new owner will get a large increase in their property tax bill. It can also have an effect on the property tax base over time. As it says, California's property tax 13 reduced the tax base substantially, as did Florida's limit and Michigan's limit. And it can have, it may or may not have an effect on government revenues. As I said before, depending upon what happens with the rate and other things, there may be no effect on government revenues. Academic studies of assessment caps show some revenue decline relative to areas without assessment caps, but generally not that large. Other effects of assessment caps, and I'll go through this a little bit quickly, it can have an effect on predictability and visibility because it just makes it harder to understand the tax burden that you have. You may have a house that looks very like your neighbors, but because differences on when the assessment caps were put in or what happened with sales, they might not have comparable tax burdens, and it's certainly difficult. And this is particularly a problem as you get new entrants into the community who might not really understand the property tax situation. So all of those things make assessment caps really complicated to understand once they've been in place. And a kind of fairly complete study of assessment caps put out by the Lincoln Institute found that assessment limits are often put forward as a means of combating increasing tax bills and the redistribution of tax burdens. In fact, 30 years of experience suggests that these limits are among the least effective, least equitable, and least efficient strategies for providing tax relief. So among, I think, property tax scholars, assessment caps have a rather negative limit. Alternatives to this are to cap, instead of capping assessments, you can cap tax rates. And these also have some problems that I'll talk about briefly. They can more severely constrain low property wealth jurisdictions that often have the greatest need for revenue. They can increase borrowing costs because lenders don't like to see rate limitations when they lend to local governments because they're concerned about getting their bonds serviced. And they can lead to deterioration of infrastructure if the government simply doesn't have enough money to pay for the infrastructure maintenance. And in particular, they also can lead to budgetary distortions as spending is pushed off budget, or they try to find ways of governments trying to find ways of revenue, raising revenue other than the property tax when they hit their rate limits. Alternatives are you can have a spending or a revenue cap, and that typically leads to greater use of fees and privatization. It can lead to severe constraints on spending if inflation is high, because generally the spending caps are don't fully take into account inflation or use a measure of inflation that doesn't measure government costs. But if an inflation correction is allowed, such caps can actually increase spending, because in those cases, governments often attempt to preserve room for spending in future years and view spending and revenue limits as minimums. So what are some alternatives to these policies that have a lot of limitations to them? So one possibility is, if your concern is that it costs too much for homeowners to pay their property tax, is to put in some kind of homestead exemption or some kind of credit. And you might want to think about making this related to the income or the wealth of the homeowners. And that could be combined with number 2, which is circuit breakers. You could also simply have different tax rates for different types of properties, different tax rates for residents as opposed to businesses. And I know you already have kind of a different system for agriculture. I know that there may also be constitutional restrictions on what you can do there. Another possibility is to simply say, if your concern is that there are elderly residents that don't have the cash to pay their property taxes, they're getting big increases in the value of their house, but that doesn't pay their property taxes today, is to allow tax deferrals. So simply keep track of how much tax they would pay if they owned it, if they were to pay it today. And when they sell their house, you can take some of that money in unpaid property taxes for the future. You can keep track of that. Some places have tried this. Quite honestly, there hasn't been a lot of take up often, but it's something that I think is something you might want to consider. The fourth, maybe much bigger kind of policy change you might consider is simply increasing state aid to local governments or state aid to taxpayers directly, such as a property tax credit program that can address over-reliance on the property tax. So those are 4 quick things that you might consider. I want to caution that any of these policies can have unintended consequences, so you have to think through them carefully in your particular context. So I will stop there, and anxious to hear your questions. And I guess I'll stop sharing.
Great, thank you so much, Dr. Merriman. We do have, I want to have one point of clarification, and we have one question so far and a couple that we prepared as well. So you had an early slide and you showed that the intergovernmental revenue was well behind the national average. And I just want to clarify for everyone that when you say intergovernmental revenue, that would be like state aid to local governments, correct?
Yes, that's right. That's
okay,
right.
so again, showing a heavier reliance on property taxes and less of that intergovernmental revenue. So I just wanted to make sure everyone understood what that term meant, since we usually talk about it as state aid. So
I apologize for
use
it throwing jargon, and I tried not to.
No, that's all good. So we also had a question, and this may be something that I'll answer first, and then if you have other observations. The question was, are you aware of any political subdivisions that froze property tax assessments for tax purposes as residential property values inflated during the pandemic? And in Nebraska, that's we have a limitation there because the law does require that properties be assessed within 92 to 100% of market value. So the assessor can't, under current law, just say we're going to freeze this year because they do have a legal obligation. But I'm wondering if you have any experience or thoughts on that question.
I don't know. I haven't heard of any political subdivision that explicitly did that. I know in my own area, the assessor, normally properties would be assessed at January 1st. And there was some, the assessor had some leeway, and he moved the date of the assessments such as sort of to reduce, actually to adjust for the pandemic, which is quite controversial, but it was legal apparently.
Okay, I'm actually not sure if that is legal in Nebraska, but we can certainly look that up. And when we send out our follow-up notes, we can include that there. I don't remember. I know the 92 to 100% of market value, but I'm not sure what the date restrictions are. I would also, one other thing I wanted to clarify from your presentation, and you brought this up, in Nebraska, residential and commercial have to be assessed at that 92 to 100%. But under our Constitution, ag can be assessed at a different percent. So it would but residential and commercial have to be valued at the same range. So, all right, we've got several questions coming in. How do we combat the popular misconception that caps are good for homeowners?
I think that takes a lot of a lot of work. Frankly, to make people understand the property tax system. I think, to try and the best way for people to understand the property tax system is that assessments determine the share of the property tax that you pay. They don't directly determine the amount of the property tax. And I think the best way to kind of keep that message, get that message home to people, is to try and keep, frankly, I mean, it takes a lot of education, but also to try and keep the property tax system as simple as possible. The more complexity you put in the property tax system, the harder it is for taxpayers to understand really what the basis of their payment is.
Great, thank you. So I want to ask, Senator has a question. What if you place assessment caps on all property to slow down the steep increases in values?
Well, okay, so if you place assessment caps on all property, you're going to have potentially inequities, because some types of property are going to appreciate faster than others. For example, you're freezing in the, I guess, the pre-COVID or the pre-run-up kind of situation. And if what is happening is that business property, commercial property is falling in value relative to residential property, then you're essentially, by freezing the assessments, you're putting more of the burden on business. Maybe that's what you want to do, but that's what's happening. That's what we would be doing. So I guess I think it's much more straightforward to say, okay, we want assessments to reflect market value. It's a technical job. The valuations, I guess you call them in Nebraska, valuations should reflect market value. And then if you don't like the outcome of that in terms of the shares that different groups are paying, then you think about what policies can you put in to compensate those people who you think are paying too high a share.
So let me follow up more on the assessment cap. So you illustrated how it could potentially increase the burden on commercial, but in Nebraska, we've been seeing, we may see double-digit increases in one area and negative growth in another. Can you speak to the impact of assessment caps in that case?
Right, and that's true as well. Thank you for bringing that up. Yeah, I mean, and that is also what we saw in Illinois, and what we've seen in other places is that typically assessments or increases in valuation, the real estate market is very local. So you see high run-ups in some areas and much less appreciation in other areas. And so what we found, at least in my area, was that when there were rapid increases, they basically benefited higher value homes in most cases. And so you're giving a big benefit to high value homes and a small or no benefit to lower value homes often. Great,
thank you. Could you describe the difficulties encountered with a market value standard when less than 2% of any given property classes sell in a study period, and how you would address that?
Yeah, that is a very, very difficult thing when you get sparse sales, and that's particularly a problem with often with non-residential. Usually residential, you get more sales, but particularly with non-residential properties. And the assessors have some tools to deal with that. You can use replacement value, or you can use, depending upon the type of property, you may be able to use the income approach to that. It's really going to depend, you can do a better job of assessment when you have more resources to do the assessments. And when you have sales are really the easiest approach to use, and I think the kind of the best approach when they're available, but sometimes assessors need to use other tools.
And I'm actually not sure if the income approach, if I guess that is something we need to look into as well, whether that would be allowed in Nebraska. So maybe one thing to do is to look at the tools that the assessors can use when we have, I mean, what we're seeing now and what we've been seeing in the pandemic is that very few properties are being sold. And so that has been a challenge in ag in past years, where, you know, we've heard that a lot, where you have very, very few parcels selling. And what will happen is that the price of a parcel will really get driven up because, you know, two neighbors might be bidding against it and driving that price up because they want something that's contiguous to their current parcels. But we're also seeing that in residential now, right, where there's very few homes on the market. And so there are these extreme bidding wars that have been happening over these homes where they're selling far above even asking price. And so maybe what I'm hearing is that looking for tools that could be used if they don't currently exist, what other tools could be added statutorily for assessors to use in those extreme circumstances?
Right. And I guess I would say in terms of the income approach, one thing that is that legislation can do to facilitate the income approach is to give assessors tools to get good information about income, the income that might be generated from a particular parcel. And that sometimes, often the owner of the land, the owner of the parcel will have that information.
Great. Can you explain a bit more about a circuit breaker and also what addressing vertical equity means?
Okay, so a circuit breaker is something that a number of states have. And generally what it will look at, on your income tax, your state income tax, you'll report, or at least one way to do it is on your state income tax, you'll report the property taxes that you pay. And if the property taxes are over a certain share of your income, then you'll get an income tax refund or a reduction or an income tax credit to limit your, to make up for the higher property taxes. I'm sorry, the second part of your question was?
Oh, can you explain, I lost it, vertical equity.
Right, vertical equity. So vertical equity, we're really thinking about, how much should people pay at different points in the income distribution. So people who are making, $20,000 a year versus people who are making $80,000 a year, what do you want the tax burden to be? And the property tax in general doesn't look at income at all, but in most cases, your housing expense is related to your income. So generally higher income households are paying more property taxes because they have bigger houses, is what it turns out to be. One concern is when you think about property taxes, you have to recognize also that renters are paying property taxes, but they're paying them through their landlord. So any program that you do to kind of address inequities by income distribution, you probably also want to think about how you can do that through rental properties.
Great. And I would just flag on the circuit breakers, the homestead exemption we have in Nebraska is very circuit breaker-esque in its design.
Okay.
So after looking at Nebraska, are there some specific solutions to the over-reliance on property taxes that you would have, especially regarding ag land?
Well, as an outsider, I certainly can't tell you what you should do. I can say that in thinking about ag land and how you want to tax it, I go back to first principles, which says I want to tax any real estate parcel on its market value. And so, it makes sense to assess and use a property tax for agriculture based on market value. But you might also think, but ag has some social benefits. There are spillover benefits to agriculture. And you might think about those in lots of different ways. They preserve communities. It's beneficial in terms of the environment. There are any number of other ways. And so what I really think you should think about is use the property tax as the property tax. Don't try and make social policy through the property tax. But if you want to support agriculture in other ways, then think about how you can do that through other kinds of government credits or other kinds of programs that directly target agriculture and directly target the things that you really care about. If you're concerned about, family farmers as opposed to corporate farmers, then, have some kind of credits or some kind of program that benefits specifically them.
Okay, great, thank you. How does reliance on state or federal aid affect local spending rates and stability or predictability of local revenue?
The literature suggests that intergovernmental grants result in significant increases in local government spending, and even more so than increases in income. If the federal government, gives aid to local governments, that will increase spending. And similarly with states, with respect to predictability, it can be an unstable source of revenue. It's important, I think, state legislatures and federal legislators should think about making the revenue stable, or at least making it clear when the revenue will be reduced or increased. And so that is an issue, a significant issue for local governments. And any kind of, often states that do have intergovernmental revenue will allocate it by formula, which makes it more predictable for local governments, rather than doing a kind of on a year-by-year basis. It's kind of a continuing revenue source for local governments.
And I think that was the initial intent with our K-12 funding formula, TIOSA. We have a formula and that spits out a number, but sometimes when the state has less revenue than they expect, that formula gets tweaked, and so has caused some predictability issues for some of our schools.
So I guess I want to say, yeah, I mean, and one of the virtues of the property tax, I think, is the local control of revenue, and it's not subject to that kind of as much instability. Do property tax levels affect companies and individuals moving to lower tax states, or is it based more on other taxes? So that's kind of a loaded question, but anyway, I think first of all, I'll say that the property tax is the most important business tax. It's people often talk about corporate income taxes. They're actually much less dollar for dollar than the property tax. So it's a very important tax. The evidence is that the tax burden has only relatively marginal effects on business locations. Much more important to business locations are the quality of the labor force in general, the quality of government, the quality of services, of government services, those kinds of things. So, the property tax is more of an issue in a metropolitan area. If you're talking about moving from one suburb to another suburb, the property tax can affect the location, and particularly it can affect the location of, things like car dealers or retail sales, that kind of thing. So you do want to think about that. The one thing is to try and do regional kind of not let things get too much out of whack in a region, and maybe even reduce the amount of intergovernmental competition between governments within a region.
Okay, yeah, no, that's helpful. So basically, so you don't have significantly higher property taxes and a jurisdiction right next to the right next door.
Right. I mean, unless those property taxes are accompanied by services. So you can have, you know, in my area, for instance, the central city has very, very high property taxes for business, but we're still attracting a lot of business because it's an incredibly, you know, incredibly good place to do business. So, but you don't want competition. You don't want governments to be competing with each other and sort of have a race to the bottom. That's what you want to be careful about. And that's particularly true with suburban areas.
Great, thank you. We'll go to a couple more questions. We still have a lot we haven't gotten to. So there have been discussions of moving ag land valuation from market value to use value. What are the pros and cons of that method?
Okay. So I mean, I understand there are various kinds of formulas that you can use for use value. And I think the important thing is the market value, again, depending upon the frequency of sale, can be more perceived as more fair and more easy to understand than use value. But let's assume that you got a use value that is visible, and that's people perceive as fair, and market value that is perceived as fair. The difference would be that a use value would be a way of preserving agricultural land, and that would allow kind of might distort market locations, might distort land uses, might be inefficient from an economic point of view. If what you want to do is preserve agricultural land, you want to keep land in agricultural uses because there are some social benefits of it. Again, I would much prefer to have market value valuations for agriculture. And then if you want to preserve it, then particularly aim your subsidies at that specific goal. Develop a program specifically for the objective that you want to achieve.
Great, thank you. I'm going to ask one last question, and I apologize to everyone who, if we didn't get to your question, and we will try to follow up with Dr. Merriman and get those additional questions asked and include them in our summary that will come out in the next few days. So in rural areas in Nebraska, about the only thing taxable is real estate farm ground. And then we have droughts and floods and frost will wipe out net income. What are local governments to do?
Yeah, that's a difficult situation, basically, because you get these times where it's really difficult for the taxpayer to pay. They still have a valuable piece of property, but maybe they don't have the income in that particular year. I guess, you know, that what local governments can mostly try to do is to build up rainy day funds, and to be that is a kind of a savings fund, and to kind of try and smooth things out in that way. That requires kind of some forbearance from taxpayers, because if you have that kind of savings funds, it means at some point you're going to have a pretty big bank account during a good time, and the taxpayers have to be willing to continue to understand. So there's really an education process to make taxpayers understand that it's necessary to do that, because you may have a drought next year, or you may have floods next year, and then they want to be able to lower the taxes in those future years. And it's also incumbent upon the local officials to do that responsibly.
Great. Well, thank you so much, Dr. Merriman. We have so many questions and still more to be answered, so we'll follow up with you on that. To those of you, again, please look for that follow-up information if we didn't get your question answered, and thank you for all of the questions that were put in the Q&A box. Thank you so much for everyone for tuning in and being so interested in this information. And Dr. Merriman, you did an excellent job presenting, you know, really talking through the different options that we can be thinking about and the pros and cons of each as we continue to have these discussions around property taxes. We so appreciate you being that resource to us and to the legislature. And so with that, I do have one final announcement for everyone. Thanks again, Dr. Merriman, and thanks to everyone tuning in. It's a very bittersweet announcement, but we'll be sharing publicly in a little bit that after 10 years, I'll be stepping down as the executive director. It has been just an incredible honor, and I'm so proud of what our team has accomplished with the support of those of you who are tuning in today and all of our incredible donors. We just have an incredible team that I'm so grateful for. So thanks so much to everyone for helping to make us such an impactful organization, and you'll be hearing more soon. Keeping it short, so otherwise you're going to start seeing tears. And anyway, thanks so much to everyone, and more soon. Thank you, Dr. Merriman. Take care.